What's going on, bull runners? Hope you guys are having an amazing day today. So turning $10,000 to over $10 million. How is this possible? I want to teach you 10 things I learned from billionaires on how they invest and how to invest not only in XRP, Bitcoin, Ethereum, crypto, but across multiple different industries. So when I listen to people, I like to listen to people who have the results that I want, number one, and people that are billionaires. It's undeniable. You can't ignore it. You can't hide from it. Hide your kids, hide your wives, but you can't hide from a billionaire that has the results that you want. When you listen to them, the results come second nature, because the more time that you spend listening to people who have the results that you want, your results come by default through osmosis and through application. And so we're gonna move the car real quick, jumping in the Bronco really quick. Check out this interior, guys. This is actually one of my favorite interiors that I could ever have in a car. Blue and black. Look at this with the custom Ford Bronco. Gotta love it. My first car that I ever bought was with money that I earned working at a hospital, scrubbing dishes for $7.50 an hour. I made minimum wage, and it was frustrating because I worked hard, right? I thought I worked harder than everyone there because, I wanted to get done early. So I scrubbed dishes. I did that for 4 years, and sure, I didn't do that for 30, 40 years, because it only took me 4 years to realize. And I'm going to be careful here while I'm moving the parking spot, moving it closer. So I'm gonna give you guys these 10 tips in this video, and I want you to write these down, because this changed my life completely. Going from scrubbing dishes in a hospital to having a portfolio that I'm very, very happy with. Obviously, I'm going to keep growing it. And I know you are growing your portfolio in stocks and crypto and real estate, precious metals. And so the main key here is number one, all right? Number one, obviously, to comment 777 if you're feeling blessed. Comment 777 if you're feeling bullish. And as I back up the truck and you get ready to back up the truck, grab the bags, pack them and stack them, these 10 tips will completely change your situation right now. As always, this is not investing advice, not financial advice. Don't buy, don't sell anything. Take this as educational material only, entertainment purposes only. But if you're going to become the first millionaire in your family tree, you know what to do. Confirm it by tapping the subscribe button, tapping that like button, and let's run it. All right, bull runners, welcome back to the channel. So number one is reverse emotional investing. So Jim Rohn, one of my mentors, I love listening to this guy consistently. Over a decade ago, before he passed away, I was absorbing all the information he talked about. And he says, walk away from the 99%. Don't talk how they talk. Don't think how they think. Don't do what they do. Join the 1%, because the 1%ers, they operate different emotionally. Their emotional frequency that they're on is a completely different vibrational frequency. So when I talk about reverse emotional investing, it's very, very simple. So it's the market moves off two emotions, okay? And that's greed and that's fear. If you base it down to two emotions, greed and fear. Sure, there's a lot of emotions in between, but when the markets are in max euphoria, max greed, that's when the masses, the 99%, are getting into the markets. And what seems very simple, you're going to learn some aha moments in this video here that's really going to transform your investing and your unconscious mind, your investing decisions and your unconscious mind, with how you invest consciously, to where you don't even have to think about it. You just do it. It's second nature. You become unconsciously competent in these 10 investing tips. So reverse emotional investing. Buy when the fear is maxed out, and sell when the greed is maxed out. So if you're in the real estate market, when everybody's getting into real estate, everybody's excited about taking out loans for a home, everybody's jumping in, that is the best time to get out of the markets. And so you guys can share your thoughts in the comments below on the best time to get out of real estate, or if it's always a good time to get into real estate, depending on how you're doing it. Right, depending on how you're doing it, if you have passive cash flow. But in crypto, in stocks, crypto and stocks is more of a volatile market because it's not as tangible. But you look at markets like physical markets, like precious metals, gold, silver, then you see like the real estate market. Well, gold and silver, it's very, very easy to spot. Crypto is a little more challenging because it's a newer industry, but based off the 4-year market cycle theory, Bitcoin moves off of its halvings. right? After Bitcoin's halving is when we go into the next bull run. So that's going to happen 2024. So we're not yet out of the woods yet. I do believe we're going to see one final dip for Bitcoin, and then we're going to go into a crazy bull run come 2024, 2025, if the economy hasn't melted down yet. So the fear for crypto is not at max pain yet. Now, I could be wrong here because the adoption that's taking place, but still, the Federal Reserve is tightening on their balance sheet. They have, offloaded a lot of bonds. They've basically not printed as much money as they should be printing. Well, then again, they shouldn't be printing this much money in the first place, but the amount of money that they have printed in the past is what caused the bull run. So to each its own on that, but reverse emotional investing. Very, very simple. So you don't need to know, the cogs of the puzzle too much of the Jenga ladder of the economy that the Federal Reserve, the central banks, the IMF, the World Bank, and what's going to happen in these markets moving forward. You don't need to know every little detail. You just need to know how the 99% operate and move the opposite of that to join the 1%. So reverse it. You're going to notice that even when you're aware of this, your emotions are going to take over. And so when the greed starts really getting up there, when we go in the next bull run and we start reaching the euphoria stage, you're going to want to put some money in the market when it's the worst possible time to do that. And over the next, 1 to 3 months, you're not going to want to put any money into the market when the fear is at a maximum, when it's the best possible time to put money in the market. So that's number one. It is the reason why it's number one is because it's the easiest to spot, but it's the most difficult to do. It's the easiest to spot logically, but emotionally it's the most difficult to do because you're asking people to change emotions, right? Emotional decisions, because we're emotional creatures, but we justify with logic. So number two, how you prevent yourself from, even if you do make a mistake emotionally in your investing decisions, is don't invest more than you can afford to lose. Okay, this is one of the most bare bone basics, but the key with what billionaires do is they don't overcomplicate the basics. You master the basics, because in order to be a master of investing, you have to master the investing basics. And so a lot of people jump into the markets and they watch a video about XRP. They watch a video about Bitcoin. They see Michael Saylor, Raoul Paul. They see, some Bitcoin bull, Mike Novogratz, talking about Bitcoin on CNN, CNBC, and they're like, or they see a Matt Damon commercial or something at the peak of the bull run, and they're like, oh, Matt Damon's talking about it, Tom Brady's talking about it, I'm going to put my life savings into Bitcoin, or I'm going to put my life savings, I'm going to sell the family farm, and I'm going to throw it all into XRP. That's the worst possible thing that you can do. Ask yourself this question right now as you look at your portfolio. And as the phone falls on the ground right here, I hope that's a good pattern interrupt for you guys, but ask yourself that right now. If the markets were to crash, just like my phone fell on the ground, would you be absolutely wiped out? Would you be wiped out? Would you not be able to pay your rent? If the answer is yes, then you invested more than you can afford to lose. So that's number two, okay? Ask yourself, based on your portfolio right now, if the whole entire industry with that bucket of your portfolio that you're invested in, whether it's real estate or whether it's crypto or whether it's stocks, if stocks went away completely, would you be completely wiped out with the bucket of your portfolio that's invested in the stock market? If the answer is yes, obviously you broke rule number 2. Now, number 3, diversify your investments. So that's why you don't want to have everything in crypto. Number 1, you don't want to have everything in one industry. Number 2, if you do have everything in one industry, you broke rule number 1. But let's say you broke rule number 1 because you're young, you're feeling bullish, you're more risk tolerant. Well, number 2, if you have everything invested in crypto and you're investing everything in one project, you're breaking rule number 2. Never invest more than you could afford to lose in one industry, and never invest more than you could afford to lose in one project. So depending on your portfolio strategy, let's say, for example, you're going to put in, holy cow, we're upside down now. All right, we're going right side up here. Let's say to get right side up with your investing portfolio, you're going to put in 10% of your net worth into one industry. Well, how would you diversify that? How would you diversify your investments through that? Well, let's say you're picking, 10 different projects in the crypto space. Well, you could have, let's say 25% of your portfolio, hypothetical, I'm not telling you exactly what to do, but you could have 25% of your portfolio into large caps, large market cap projects like Bitcoin, Ethereum, XRP, you know, any of the largest by market capitalization. Number two, you could have 25% in the medium caps. The medium caps would be anything, you know, underneath $1 billion, but above $100 million. And then you could have 25% of your portfolio in the small caps. And so the small caps would be, you know, it could be small to micro cap coins, you know, anything that's like just starting out, up to, you know, 10 million, $100 million, whatever you feel would be, you know, good for your small cap or your micro cap investments. And then number four, you could have 25% into stable coins as dry powder to be able to accumulate the dip for your favorite large caps, medium caps, or small caps. That could be an investing strategy. But let's say your amount that you could afford to lose that you're putting into the markets, if you have $1 million portfolio, is 100 grand. Well, then out of that, you're only putting like 10 grand in the markets and you're diversifying that amongst $1,000. And so you still have some cash, you know, saved aside. Now, obviously for me personally, I'm more risk tolerant. You know, I personally feel that I'm more bullish on crypto. I'm more bullish on precious metals like gold and silver. I'm more bullish on real estate. So a larger chunk of my portfolio would be in real estate, precious metals, and crypto than it would be in cash. But having a good reserve of cash as well too, you know, saving for an economic downturn to be able to purchase food. But then again, I'm not just like stacking up cash. I would rather buy, you know, survival based foods in the case of a pandemic, like cans of tuna, oats, right? Stuff that's not going to go old for 3 to 5 to 6 years in case there's another lockdown and everyone raids the grocery stores. And so, you know, as inflation goes up, owning food is actually better than owning cash. Food that doesn't go old, survival-based food. So you could be a survival prepper if you want to, but don't go too off the wall and too crazy with that. So investing more than you can afford to lose, right? Diversifying your investments. And number four would be start early and harness the power of compound interest. So starting early could be early in your life or early in the industry's life. Meaning, if you're young, you know, you're 15, 16, 17, 18, you know, obviously you have to be a certain age to invest in certain industries, but let's say you're 21 years old, you're young. Let's say you're 55 years old, but the crypto industry is where it's at right now. When you're watching this video in 2023, the crypto industry is young. So that's a young industry. But so if you're a young human being in a young industry, that's the perfect match. Now, if you're a little bit older, let's say you're 60 or 70, but you're in a young industry, still a great match, right? If you're older and you're investing in an old industry, it's not the best match. So the best match is young human being, young industry that has a long lifespan. So blockchain technology, distributed ledger technology, cryptocurrencies has a long lifespan. Now, obviously, crypto is going to change because you go to coinmarketcap.com, there's like 1.8 million cryptos. Made a video a few months ago, there was like 30,000, 20,000 cryptos. Now there's 1.8 million. They just added so many more. So 99.9% of cryptos are going to get wiped out, and the ones that are going to stay around are the ones that have utility. Now, in terms of compound interest, you can do stablecoin staking. You can stake USDC. You can stake USDT on like crypto.com, on coinbase.com. You can earn like 3%, 5% compound interest per year. APY, annual percentage yield, if you want, and you can compound that over time. So as the industry gets more popular and as you get older, well, then you're going to have that compound interest stack upon itself. So that's a good way to have stable coin staking is a real key to look into that. Now, the moment that you start getting into like 20%, 30%, 40% APY or monthly percentage yield. I know a lot of these companies, you know, they'll promise 1% a day. The majority of those companies are scams. They're going to go away. They're going to get shut down, and they'll only last max like 3 years. You know, I haven't seen a lot of these companies last more than 3 years. You know, a lot of these stablecoin companies that shut down really quick because they're promising too much income and they can't sustain that. They can't sustain that. So you just have to be very aware, you know, 1 to 5% annually is realistic. And, you know, you're doing that to beat inflation of the dollar, because the dollar's inflation is like 3.7% last month. And it's actually probably double that. So, you know, based on what Jim Rickards was saying, it was like
6% or 7% or something around there. So you're trying to beat inflation, or at least maintain a stable level of your currency as inflation increases over time, or we go into potential hyperinflation. So number 5, set clear financial goals. A lot of people don't even start with the end in mind. They don't even know what they want their portfolio to look like. They don't even know what they want their lifestyle to look like. They haven't written down any of their goals. They haven't grabbed a notebook. They haven't jotted or journaled out what their dream lifestyle would look like. Writing it in the present tense. I am so happy and grateful now that I am what? Or now that I have. Now that I have in my possession what? What do you have in your possession? What's your portfolio at? What house are you living in? What car are you driving? How much money are you currently making? Jotting down your goals. This should honestly be number 1. It's the most important, because how do you expect to hit a target you can't even see, let alone a target you don't even have? That's the key. A lot of people, they're blindfolded throwing darts at a target that isn't even there. Now, when you have a target and you throw your dart, or you shoot your shot. Fire, ready, aim. Most people, they get ready, they aim, they get ready, they aim, they get ready. Most people don't even make it to the aim, and 99% of people don't even shoot. They just get ready, they get ready. Well, why not? Fire, get ready, aim. Shoot for something, then get ready, then aim and recalculate, and you'll know where you hit. If you didn't even hit the target, now you're aiming. Now you know what you're looking at because you wrote down your goals. This is big. This is big. You have to do this, okay? You have to do this. You have to write down your goals. You think it's corny. I get it. You think it's corny, but if you haven't made over $1 million in a year, let alone a month, I get it. It's corny. It's corny to write down your goals because nobody's taught you to do that. Well, guess what? Would you rather write down your goals and be a little corny on some of your goals and have $1 million, have $5 million, have $10 million in the bank or in your portfolio, let alone 50 million, 100 million? Or would you rather have no goals, have no income, be working in a hospital, scrubbing dishes for $7.50 an hour? I think you know the answer to that question. So clear, very, very clear financial goals. Now you can have a time frame on them or not. I think dates create doubt. As long as you're going to keep going until you hit your goals, you're going to hit your goals. You have 2 options, all right? This is goal setting and how you achieve your goals. You give yourself 2 options on your goals. You don't give yourself a date. I never write down, I'm going to achieve this goal by December 31st, 2023. You can do that, but dates create doubt. You give yourself 2 options. Option number one, I hope you're writing this down, is I am going to hit my goal. Option number 2, I'm going to die. Those are your options, okay? You're either hitting your goal or you're going to die. Now, if you don't hit it by December 31st, 2023, based on the time frame you wrote down your goal, it doesn't mean you're going to die. What it means is that you're going to keep going until you hit that goal, or you're dead, whichever comes first, okay? When you do that, hitting your goal is inevitable. And if you don't hit your goal, you're dead, so it doesn't matter. So that's the key. That's the key to hitting your financial goals, okay? That's how serious you have to be about goal setting. That's how serious you have to be about your dreams. Nobody can stop you. Now, the people that believe in you, bring them along with your vision. Help them set their goals as well, too. Now, number 6, think long-term and don't risk your long-term portfolio for short-term gains, okay? Having a basket for short-term risk, is something like maybe 20% or 10% or less of your portfolio, whereas 80 to 90% of your portfolio is for long-term investing, long-term compound interest. A lot of people, they'll invest long-term, but then they will steal from their future to invest in today, and today is not always promised. It's not always promised. And so today might seem like, 80% returns in 30 days. Holy crap, this new company, this new stablecoin staking platform. Maybe I should take it out of my long-term investments and put it into that. And then you do that, and then the company goes down. The company shuts down. The company goes under. That happens. Ish happens, right? It's life. Stuff happens, okay? You have to be ready for stuff like that. you have to be ready for that. And if you're taking from your long-term portfolio to invest into today, something that seems like, oh, wow, this is going to 100x, in 30 days because you see some crazy YouTube title or some crazy promise from some company or something like that, don't do it. Okay, don't do it. Have a bucket of your portfolio that is designated towards that, but don't overdo it. And if you're going to put more into that risky bucket, you better have passive income on the front end. So that leads me to number 7. Only invest in what you understand. If you don't understand it, don't invest in it. You don't need to diversify so much to the point that you're spreading yourself too thin, investing in 20 different industries, like in solar panel and, water and food companies and a new, dog walking business and cryptocurrencies and a precious metals into real estate company, into a, development construction company. If you have all these investments that you're pouring money into and you don't understand 99% of them, well, you're most likely going to lose 90 to 99% of your income. See, you can have a few different industries, 2 to 3 max. I wouldn't go past 3, honestly. A lot of people that invest in 3, 4, 5 industries, they completely screw themselves over because they're not a master of one. When you master one industry and you invest in one industry, well, you're going to make most likely 80% of your income from that one industry, if not more. And then the 20% that you're going to be able to earn from other industries could be an industry you've never touched before, and you're investing with people who understand it. That's one way. But if you don't understand it, don't invest more than you can afford to lose in something you don't understand. It's that simple, right? If you don't understand crypto, I know it can be very, very confusing. Take time to learn about it. Subscribe to the channel, like these videos, educate yourself, do your own research, right? I'm a big advocate for doing your own research. Watch these videos, absorb what you like, disregard what you don't. You don't have to take everything I say as law here. Okay, absorb what you like, disregard what you don't, and only invest in what you understand. Now, number 8, time in the markets beats timing the markets. That's a nuanced point there. Time in the markets beats timing the markets. So if you're trying to time the market, meaning timing, you're trying to time the perfect entry, time the perfect exit point, time the perfect trade, buy at the right, best possible time, sell at the best possible peak, right? Buy at the best possible low of fear, sell at the best possible point of greed, of euphoria. You'll never catch the top, you'll never catch the bottom. That's what you have to understand. But you are buying and selling relative to what's cheap and expensive compared to the past and compared to other industries. You are buying and selling what's cheap versus what's expensive compared to other industries and compared to the past. And so, for example, if you look at the Dow to gold ratio, this 100-year historical chart, it talks about, or it shows, the Dow, what it costs to buy the Dow with an ounce of gold at any given time. And so anything above 15 is bullish for gold, bearish for stocks. Anything below 5 is bearish for gold, bullish for stocks. We're at like 17 right now. So what's relative, meaning it's more bullish for precious metals than it is for the Dow Jones Industrial Average. Now, in terms of time in the markets, well, if you were to try and time it, you can time the markets, you can do that, but you'll never catch the top, you'll never catch the bottom. That's what you have to understand about timing. But in terms of time in it, well, if your grandpa would have invested just $100 in the S&P 500, 100 years ago and passed that down to you, you would be up. If you put $1, you'd be up $200 on that. So you'd be up, is that 2,000% or 20,000% or something like that, just by having time in the markets. And so if you invest for the long term and then focus on creating more passive income. It's really that simple. There's been so many projects that I put money in that I've lost money. I've lost money in a lot of stuff. So some people hate on me saying this project didn't work out. I'm like, yeah, it didn't work out for me either, man. I lost money. I lost a lot of money in a lot of stuff, and it's frustrating. It sucks. It's not fun. I get it. Okay. I understand you. I feel you. It's not fun, to lose money. Warren Buffett's rule is never lose money. Well, that's a very difficult rule. That's a good rule to have, but that's a very difficult rule to live by, because you're bound to lose some money at some point. But if you can make smarter decisions on having, long-term investments and have time in the markets, where instead of day trading every 24 to 48 hours, trying to move money into this project or this forex pair or this cryptocurrency or, you know, this deal or this or that, you're stressing yourself out. You can barely sleep at night because you always have to check your portfolio and wonder where the next trade is going to come from, rather than focusing on creating more passive income on the front end and then just tucking money away into real estate, tucking money away into precious metals, tucking money away into the crypto projects that you believe in. Number 9, focus on quality investments over quantity. When people get into crypto, they try and buy every possible altcoin that pops up on their feed. They're like, oh, this one looks like a shiny new thing. Oh, this is a shiny new thing. You see the same thing in network marketing, affiliate marketing, and any industry where people are just bouncing around like a squirrel that sees an acorn and they're like, ah, new nut, gotta get my nut. Gotta get my fix, right? I gotta get my altcoin fix. And so they jump into all these new altcoins, and pretty soon they got 70 or 80 or 90 altcoins. I'm actually curious. Social experiment. Right now, comment how many altcoins you're holding in your portfolio. If it's over 25, you have way too many of them. I would even say congregate even down from that. 25 is a lot to even manage. I would even have less than 10. I would have less than 10 in your portfolio. And the amount that I have in my portfolio, I really hold, I think, like 7 or 8. You know, the riskier portion of my portfolio, those are the ones that I don't even consider as really a part of my portfolio. Those are the ones that it's like, hey, they could do something, they could not. But ultimately, the ones that I'm actually monitoring and actively monitoring is less than 10. The others, I'm like, I got like $100, $20, maybe $500, maybe $2,000 in some of these ones. You know, if I'm holding, like, for example, 25 altcoins, but I'm not considering those as like the ones that I'm watching consistently when I check my portfolio every single day. Now, I'm not micromanaging my portfolio, I'm just checking it. But because I have less than 10, it's a lot easier to manage. It's a lot less stress as well too. And so when you focus on quality, what is quality in terms of investment? Well, what drives a quality investment? It's utility. It's the team behind it. It's the long-term vision of what they have. It's what they're currently accomplishing. How many people are backing it right now? If something is new, something has a big vision for what utility they want to strive, but they're not achieving anything, well, then that's a riskier investment. Whereas something, for example, Ripple as a company, they have just stamped this whole industry alongside Bitcoin. There's nothing else that can compete in terms of the altcoin space to XRP and to Ripple as a company, because they have the clarity that they need that XRP is not a security. And so quality, XRP is quality, Ripple as a company is quality. Bitcoin, the technology is a little more outdated, but still in the crypto space, it's considered quality because of the ETFs. It's because, you know, Bitcoin, it's better than dollar, obviously. It's better than a lot of stuff out there, but it's not better than a lot of the newer technology that's popping up. It's not better than XRP's transactions per second. They upgraded XRP's transactions per second to, you know, over like 3,000 now, which is crazy. Bitcoin is 7 transactions per second. So Bitcoin's a lot slower, but it's considered digital gold. So, you know, you got like Bitcoin, XRP, then you have, of course, Ethereum. William Hinman messed up in his speech saying that Ethereum's not a security, and I believe Gary Gensler said that as well too. So I don't think they're to go after Ethereum. You got the old school ones like Bitcoin Cash, Litecoin, that are on Ripple's liquidity hub for massive banks to be able to use. And then you have other big projects you guys could believe in. Maybe believe in Solana. Dogecoin's another big one as well too. And it's funny because Elon Musk is bullish on that. So Dogecoin, I think, is going to take off, do big things. But the dollar's not quality. You know, in terms of quality in other areas, gold, actually owning physical gold, physical silver, real estate, having land, you know, multifamily homes. You know, for those of you that are experts on real estate, you can educate people in the comments below in that market as well too. This market, we're talking about crypto. In terms of the stock market, you know, quality in terms of the stock market, well, that's tough to say nowadays because of the timing and the volatility. I'm not investing in the stock market right now. I believe we're gonna have a massive crash in the stock market. We're seeing the greatest transformation of wealth we've ever seen in history. And that's why it leads me to number 10 is dollar cost average. If you see the markets dip, don't invest the entire chunk of your portfolio that you can afford to lose into one project or multiple projects. Dollar cost average it, right? Take a certain percentage and put it in the projects that you believe in. And don't take all of it, because if the markets dip even lower, then you're sitting there, sitting on your hands, sucking your thumb, wondering like, okay, well, I don't have enough passive income right now. How am I going to put more money into the markets? So the real key is to DCI, dollar cost average. And if you follow those 10 rules, guys, I promise you, your entire life will change. Now, I'm not making any guarantees that you're going to make money because investing involves risk. Common sense would suggest that, it takes intelligence, it takes skill, it takes research, do your own research, and most people lose money in the markets. But I know you're not most people. I know that you're willing to walk away from the 99%. You're willing to do what the 1% do. Don't think how the 99% think. Don't do what they do. Don't invest how they invest. Don't live how they live. Watch the 1%, do what the 1% do, and your life will dramatically change. So as always, you know what we're doing. We're backing up our truck all the way to the bank. When I used to work at that hospital scrubbing dishes for $7.50 an hour, I saved up enough money to buy my first car with my own money. And it was a Ford Bronco. It was in the 90s. Ford Bronco in the 90s, and I had to sell that car to keep my business going. And after following these laws right here and other laws that I'm going to unveil to you on this channel in more videos, if you subscribe to the channel, if you want to see more stuff like this, I will show you how I completely transformed my financial situation. And I'm not perfect, obviously. I know we're human beings. For me to say that I'm perfect and I'm some guru here, be lying to your face. Anyone that says that they're some guru or they're an oracle of something, that person is full of you-know-what, and they need to go to the bathroom. So we're backing up our truck to the bank, grabbing the bags, packing them and stacking them, leaving no bags left behind because the spending power of the dollar is going down in value. That's the truth. And blockchain technology is going up in interest. That's a fact. And together, we're all going camping on the beaches of the moon. I will see you on the next video. I will see you on BULLRUNNERS.com, where you'll learn our #1 way to earn passive income online without any crypto trading experience. I highly encourage you, go check that out. You're going to receive up-to-date information on our video newsletter every single day on what's happening in the markets. As always, you know what to do. Stay bullish.